Thanks all for being here this morning. My name's Nat Kellogg. I'm the Director of Manager Search here at Marquette, and I'm going to be kicking off the Marquette Research portion of this morning's symposium by delivering the first of our 6 flash talks. Now, a little logistics to get out of the way first. Each flash talks will be 15 minutes in length. We're going to split them up into 2 sets, so we'll do a set of 3, have a short break for coffee and refreshments, then another set of 3. And then last but not least, we aren't taking any formal Q&A, but all the speakers here this morning will be up near the front of the stage during all the breaks. So if you have any question about any of the material we cover here this morning, please feel free to come up and chat with us. We'd be happy to talk. So with those logistics out of the way, let's jump right in. As Brian reminded us, September 2018 marks the 10th anniversary of the collapse of Lehman Brothers and the onset of the financial crisis portion of the Great Recession. So what we thought we would do here this morning with a little bit of a benefit of hindsight is take a look back, look at the key causes and key events from the global financial crisis, then take stock of where we are today, how far we've come, and then the crisis obviously laid bare a number of interesting issues that we had in the financial markets and the economy. We're going to take a look at what was fixed and what still remains unsolved. Now, anything as complex and massive as the financial crisis obviously had many, many causes. But I think any honest postmortem would certainly focus on 2 key issues that were laid bare, the first of which was housing. So in the years running up to the financial crisis, a combination of very low real interest rates, relaxed lending standards, and the assumption by Wall Street analysts and most economists that housing prices, at least on a national level, would never see a coordinated drop, led to a rapid increase in home prices. You can see that in the chart here. What we're showing you is home price to rent ratio. You can think about this as a valuation metric for housing prices, sort of a PE for homes. And you can see a massive increase, almost a doubling from the late 1990s to the mid-2000s. Now, this left housing unaffordable for most Americans and also led to a rapid increase in supply. House prices peaked in early 2006, almost 2 years before the collapse of Lehman Brothers, and then began to decline. Now, given the importance of housing in the broader economy and as well as to consumers' balance sheets, anytime we saw a coordinated drop in house prices, we're almost certainly going to have a recession. But what tipped things from a recession to a financial crisis was leverage in the financial system. So beginning with the repeal of Glass-Steagall under Bill Clinton, we saw banks become ever larger and ever more aggressively capitalized. Banks slowly but surely veered away from the bread and butter business of making loans to businesses and became more involved with trading, derivatives, and the structuring of complex securities like CLOs, CDOs, and CDO squares. What this means was at the beginning of 2008, Lehman Brothers was levered 30-1. That meant that just a 3% drop in the value of their assets would lead to insolvency. Now, we all know what happened next. After a few warning shots in 2007, the financial crisis got going in earnest in 2008 in March with the collapse of Bear Stearns and the sale to JP Morgan for just $2 a share. Later on that summer, something that's sort of forgotten now because of everything that happened afterwards, but in July of 2008, we had the largest FDIC takeover of a bank to that point of IndyMac, which was a subprime mortgage lender with $20 billion in assets. And then in September, the dominoes started to go fast and furiously. Fannie and Freddie were taken into conservatorship on September 6th. A little over a week later, Lehman Brothers collapsed, and the following Monday morning, the Fed and the Treasury were forced to bail out AIG to the tune of $80 billion. Congress then scrambled to put together a bailout package, the first attempt at which failed, and that led to that 778-point drop in the Dow Jones Industrial Average that Brian referenced earlier this morning. Now, we saw a massive amount of consolidation within the banking sector during the financial crisis. By the end of 2008, AIG was in the arms of the U.S. Treasury. Bear Stearns, Washington Mutual, Merrill Lynch, Countrywide, and Wachovia, all household names to all of us, have been gobbled up by their healthier and larger peers. And Lehman Brothers was in the process of the largest bankruptcy liquidation in history. In fact, about the only industry that had a good crisis was Hollywood, as they benefited with a plethora of good movies and books. Team Research even got in on the process. We actually took a team outing the afternoon that the Big Short came out to go see that movie. So where are we now? 10 years later, what's changed? What's better? What's worse? Let's start with the labor market. So John Miller touched on this earlier, but at the peak of the recession, or the depths of the recession, I guess I should say, unemployment hit 10%. That was a level of unemployment we hadn't seen since the recession in the early 1980s, 1981, 82. And the US economy shed a total of just shy of 9 million net jobs during the year-and-a-half portion that we were shedding jobs throughout the financial crisis. Fast forward to today, and unemployment stands at 3.9%. That's a level we haven't seen since the tech bubble back in the late 1990s. And the US economy has been very consistently generating jobs. We've been averaging 200,000 net new jobs a month consistently for over 5 years now. We also hit a very interesting milestone earlier this year in 2018. The number of job openings now exceeds the number of unemployed people in the United States. So there are still some dislocations within the job market, but overall we've seen a massive improvement in labor markets. And one of the things driving that improvement in labor markets has been an improvement in the overall economy. As you can see here in the green line, during the depths of the crisis, the US economy was shrinking at about a 9% annualized pace. Fast forward to today, and with a little extra juice from the Trump tax cuts, nominal GDP growth today is north of 7%. It's the fastest rate we've seen in the post-crisis era. And one of the big drivers we've seen driving that is a return and a recovery in overall construction. What we show you here is residential and commercial construction, which you see peaked in 2006, and then underwent a 5-year, what I would call a depression. Fast forward to today, and we now see that overall construction spending in the United States is over at $1 trillion annualized pace and is actually slightly above the prior peak we saw in 2006. Now, all this good news in the labor market and the general economy has clearly filtered through to financial markets. So this is a typical risk-return chart. You guys have all seen these from us many, many times before. But this is a little different than the ones we normally show you. What we show you here for risk is not standard deviation. We show you the calendar year performance of the asset class. So you can think of this as the 2008 drawdown for this asset class. And what we show you on the y-axis is the annualized return in the decade hence. So you sort of typical risk return, but looked at it a little bit different way. And you can see on the far left-hand side here, core bonds are the only asset class in an institutional portfolio that were up in 2008. But there was a little bit of a price to pay for that. It's been the worst performing asset class in the decade hence. Conversely, US stocks, emerging market stocks, were some of the hardest hit during the crisis, have also had some of the strongest returns since. So I think this is a helpful reminder to all of us, where there is risk, there is often opportunity. You know, not only have global markets recovered, but they've also changed in their complexion a little bit. So what we show you here are the top 10 companies in the MSCI All-Country World Index. You can think of this as sort of the largest global equity index out there. We show you the top 10 weights in 2008 and now today in 2018. And a couple interesting things stand out. First and foremost, there's only 4 companies left from 2008 that are still on the list today. That's ExxonMobil, Microsoft, Bank of America, and J&J. Interestingly enough, if you look at the top 10 today, all 10 are US-based businesses. So we've seen some significant outperformance in the US over the last decade. And then last but not least, if you go back to 2008, there was only one tech stock on that list, Microsoft. Today, all top 10 stocks here are tech companies. We would be remiss if we didn't spend a little time giving you an update on where all the household names we all got to know very well during the crisis have ended up today. So Hank Paulson and Ben Bernanke have gone to work for think tanks. Interestingly enough, Hank Paulson's think tank is focused on US-China trade and relations, which his job may be just as hard today as it was 10 years ago. Tim Geithner has cashed in and gone to work for Warburg Pincus, a global private equity firm. John Thain spent a number of years at CIT, which is a commercial lender that also went bankrupt during the credit crisis, and has since gotten the technology bug and now serves as an advisor to Uber. And then last but not least, Richard Fuld, the CEO of Lehman Brothers, has gotten into our business. He started Matrix Private Capital Group. It is an investment advisory firm. Hopefully he's not advising his clients to be levered 30 to 1. So the financial crisis laid bare a number of issues in the US economy. So what we thought we'd do here this morning is sort of take stock and see what was fixed. Any of these problems have been solved. So let's start with the housing market. So what you show you on the left-hand side here looks at non-performing loans within the mortgage market. And you can see that there was a massive spike in 2008 as a number of borrowers became underwater on their mortgages and lost their jobs. And we've now seen a significant improvement over the last couple of years as house prices have begun to rise again and unemployment has dropped. This has all led through to a recovery in the housing market. So you can see in that middle chart, we show you the Shiller Case home price index, and you can see a significant recovery almost back to the 2006 peak. Now that might beg the question, is this just a housing bubble 2.0? And we think the answer to that question is most assuredly no. And the reason why is on the right-hand chart. So this looks at home price affordability. Here, lower is better, higher is worse. So you can see that in 2006, home prices were very unaffordable. Fast forward to today, and because of rising incomes and continued low interest rates, housing overall remains very affordable. If any of you have children living in San Francisco, you might beg to differ. But on a national basis, we would say that housing has very firm footing. We've seen a similar recovery and stability in the banking sector. So on the left-hand chart, what we're showing you is banks' Tier 1 capital ratios. This is basically a measure of how much equity they have relative to their liabilities. And we've seen almost a doubling of the amount of equity that banks have since the end of the credit crisis. So this means that banks are in much better shape to deal with a mild deterioration in loan performance and a slowdown in the economy. On the right-hand side, we look at bank profitability, return on equity. And here you can see that banks are nicely, consistently profitable again. That's good for all of us as taxpayers. We don't have a bailout coming. You can also see that it's a little bit lower than it was before the crisis. So banks have gone back to a little bit more of a boring bread and butter business, less profitable, but more steady. And we think with Frank Dodd reform and the annual Federal Reserve stress tests, banks are more likely than ever to stay on the straight and narrow. Lastly, the auto industry. So during the credit crisis, GM and Chrysler both went bankrupt and Ford looked into the abyss. Today, things are much healthier. So if you look at the green line here, this looks at auto sales. We're about now back to the long-term averages of about 16 to 17 million units on an annual basis. While overall employment in the auto industry still remains below where it was in 2006, it has gone up a little bit more than 50% from the low we saw in 2009. And the two largest domestic manufacturers, Ford and GM, are both consistently profitable and cash flow positive. So that's the good news. Now the bad news. There are a couple issues that were created, new issues that were created by the financial crisis, and a few things that remain unsolved. So first and foremost, the role of central banks in the economy. So you can see here on the left-hand side, the Fed cut rates in the wake of the credit crisis to help stave off deflation and stimulate the economy. Now we've slowly started a pace of normalization of interest rates, but Fed balance sheets still remain bloated. So total global central bank balance sheets, that's what we show you on the right-hand side chart here, between the Fed, the ECB, and the Bank of Japan, look at our total to $14.5 trillion. So that is a substantial increase, almost 4 times from where we saw in 2008. Now, how this unfolds is anybody's guess. This is the largest monetary policy experiment in history. It has never been tried before, and so nobody knows exactly how it's likely to end. Now, I mentioned earlier that households and banks are in much better shape today than they were 10 years ago. The opposite is true for the government. One of the lasting legacies of the financial crisis has been a large shift from private sector debt to public sector debt. So on the left-hand chart, what we show you is US debt to GDP. This was just 35% heading into the credit crisis, and today stands at almost 80%, so a more than doubling in debt to GDP for the US government. And unfortunately, there's little perspective that this is going to improve. If you look at the Congressional Budget Office projections, the deficit is likely to run about 5% of GDP on a go-forward basis. And so the CBO predicts that US debt to GDP is likely to hit 100% by 2028. Now, Fannie and Freddie, an issue that was never addressed. In the wake of the credit crisis, both politicians and economists agreed that the guarantee that the taxpayer was providing and the government was providing to the mortgage market was not a good deal for taxpayers. Unfortunately, very little progress has been made on this front. So if you look on the right-hand chart, what we're showing you is the share of the US mortgage market, or all mortgage loans outstanding that are backed by government-sponsored entities, essentially Fannie Mae and Freddie Mac. And you can see that that stands at 50% today, an all-time high. It has continued to increase in the wake of the credit crisis. And this line is likely to keep going up further. If you look at new mortgage security issuance, almost 90% of that today is backed by Fannie Mae or Freddie Mac. Now, the current administration has said that they'd like to have some plans to address this issue, but we would also point out that the Obama administration said the same thing, and this is going to be a very politically difficult issue for either party to tackle. Last but not least, too big to fail. This is a moniker we all became very familiar with during 2008. And as you can see in the left-hand chart here, very little has been done on that. The number of commercial banks outstanding in the United States has continued to decline unabated by the credit crisis. What this has done is this led to increasing concentration in the financial industry. So on the right-hand side, you can see that the top 10 banks in the US control almost half of all banking industry assets. And the top 50 banks control just shy of 80% of all industry assets. Financial industry is a very concentrated industry. Now we think with stress tests, higher capital ratios, Basel III, a bank bankruptcy is much less likely than it was 10 years ago, but it will be just as painful, if not more so, if it does occur. So in conclusion, there have been many changes to our economy and our financial markets over the last decade, which almost guarantees that the next crisis will be quite a bit different than the last one we had. We'd also point out that many people say nobody saw this coming. But actually, there were lots of people who raised concerns about the housing market, about structured products, in the lead up to the financial crisis. The hard thing is predicting not just what the issues are, but also the severity. As I point this out because there's always lots of work to worry about, but bull markets typically climb that wall of worry. Most of the things I pointed out here this morning probably won't cause significant issues for the market. But when the next inevitable bear market does hit, hopefully we can learn from 2008 that where there is risk, there is often opportunity, and if we can stick to our plan, we will be well positioned to take advantage of it. With that, I want to thank you all very much for your time this morning. I'm going to call my colleague Derek Schmidt to talk a little bit about the evolving market landscape.